This is News You Can Use.
Last week on News You Can Use, we reported that the Federal Reserve hiked interest rates for the 11th time. This prompted a simple question. When can we start to see relief for mortgage interest rates? We shared information about how mortgage interest rates are running higher than the historical norm of 2 to 2.5 points above the inflation rate because the Federal Reserve is, at this point, cautious to lay off its interest rate hiking campaign until they feel greater confidence that inflation is indeed in check. However, we identified that the two key statistics to look at were the next jobs report on August 4th and the next CPI or inflation report on August 10th. The first of those key reports happened on Friday. According to the U.S. Labor Department, non-farm payrolls expanded by 187,000 for July, slightly below the Dow Jones estimate for 200,000 jobs. Check the box. This is good news for mortgage markets as more jobs is more money in the economy, which means more demand for goods and services, which ultimately fuels inflation. Following the payrolls release, market bets that the Fed would hold rates steady at its September meeting, well, they edged up to 83.5% probability, according to the CME Group data. Though policymakers have indicated they expect one more quarter a point increase before the end of the year, markets are expecting that the Fed may be done with this rate hiking cycle. Thank God. So, what are we looking for in this Thursday CPI report to further solidify that the Fed indeed won't raise rates again? Any number that indicates inflation is holding at the 3% or lower rate should all but guarantee that the Federal Reserve won't raise interest rates at their next meeting on September 19th and 20th. If this trend continues for the next several months, we can finally expect mortgage interest rates and some relief with mortgage interest rates in the near future. And that's news we can all use.